Divya, perhaps you can provide some thoughts from your perspective, leading the charge on ESG integration and making sustainability real in the investment scene, in particular for our students here today. Could you share some thoughts with what you see as the landscape for really education? Part of this is multidisciplinary.
Yeah, sure. So CalPERS, as Dan mentioned, manages $300 billion, and it's on behalf of 1.8 million public sector employees in California. So if we shut our doors today, our liabilities would actually extend 70 to 100 years, depending on the lifespan of our beneficiaries. And so a few years ago, really post-financial crisis, we thought more deeply about our assumptions around risk and how we need to broaden those assumptions. So one of the things we did was create a new set of investment beliefs. And two of them in particular I think are most relevant for this discussion. One is that value creation beyond the traditional metrics requires effective management of three forms of capital, which is natural capital, human capital, and financial capital. And that's really sort of the ESG, investment belief. And the other one is that risk is not fully expressed in traditional metrics like volatility, which, if you've ever worked with pension funds, are very concerned about tracking error. And so this is another attempt to go beyond those typical risks and look into ESG research, look into quote-unquote non-financial factors that companies are reporting to get a broader sense of risk. And so unfortunately, we have these investment beliefs in this framework, but when you come to implementation, which is really my role, to support each of the asset classes and thinking about how to integrate ESG into investment decisions, there isn't a book that I can pull off the shelf to say, this is exactly how you do it. And the other structural difficulty I think that we have in finance in particular is that a lot of the way that we're taught finance is to look at a 30-year data set, get a trend line, and extrapolate certain things under different market conditions. Whereas a lot of the ESG risks we're looking at, climate change, for example, requires looking ahead. So you can't always, make an investment decision based on backwards-looking data. And so because of these, shifts in a more expansive idea of what constitutes risk, as well as the need to look more into the future, it becomes a very interdisciplinary field.